Hi everyone. In today's episode, we will see 6 important financial terms, the basic financial terms that everyone at whatever stage of your life you are in should be aware of. What are those 6 terms? The first one is cash flows. When you start your income, when you start your job, or when you start your business, it's a very important term, whether even you're in a college. It's an important term to understand. Cash flows are basically determined. It has 2 parts to it. It's a cash inflow and cash outflow. As the name says, cash inflow is the inflow of cash into your accounts, where it could be a personal account, savings, or brokerage accounts. It's basically the amount of that cash that you generate every month, whether it is through your income sources, whether it is through a job, or it could be through the dividends from stock investments. It could be from the rent that you receive from your real estate investments, or it could be from your bond interest rates. Whatever it is, there are different sources of cash income and cash inflow, and the cash outflow is nothing but the expenses that you incur on a month-to-month basis, whether it is run your household, whether it's run your businesses, to purchase raw materials, for example, if you're running a business, or if it is to pay stock-based compensations or one-time pensions, or if you're on your personal income, personal side, it is your household expenses. It could be your mortgage amount that you pay, it could be insurance, it could be the rent you pay. All of those are cash outflows. So the net tallying of cash inflow and cash outflow gives you what is left over at the end of every month or every quarter, the way you want to track it. And it's a very important metrics you need to track for efficient savings and investing, or if you're running a business, for efficient planning of the cash, what is required, or efficient planning to acquire required debt to run your business, right? So it is a very important term, whether it is in your personal side or whether it's in your business side. The second term is capital gains. Capital gains are nothing but, so basically we all have investments in different type of assets, right? Assets, when I mean, it could be as simple as buying a property, or buying a land, or buying a apartment, a complex, or buying investments could be in terms of machineries to run a business. It could be an asset in terms of an investment in stocks, bonds. All of those forms different types of investments. Now, how much you pay for those investments is the amount that it is nothing but the cost price, and how much you sell for is the selling price. The difference, if the selling price is higher, if you're able to sell your asset more than what you paid for, the difference is what you get is nothing but the gains or profits, right? And the capital gains is nothing but the gains that you get out of the capital that you invested in. And capital gains is an important term to understand, especially from the taxation purposes. So when you file your income tax, right, in every year, different countries have different tax slabs, right? For example, in some countries, the long term, you might qualify for long term capital gains if you just hold it for more than a year. In some countries, if you have to hold it for 3 years to qualify for long term capital gains, which are usually lower than the short term capital gains that you will have to pay. So capital gains is an important factor to understand, and there are more into it. You could just Google and do more research into capital gains, and basic stuff is this, and it is long-term capital gains and short-term capital gains. Now, the third metrics that you need to understand is, the third financial term you need to understand is return on investments. Return on investment is the most important factor that you need to evaluate before doing an investment. How much return, as the name says, how much return are you going to get on your investments? It could be a capital investments, it could be intellectual investments, it could be different type of investments that you're putting in. But what is a return? It could be a different way of calculating the returns for different types of investments. But on an average, on a general way, you calculate the difference between the profits, that is nothing but the difference between selling and cost price, and or how much capital you gain out of the investments, divided over the cost that you put in, right? So the profit divided over investments times 100 gives you the return on investment on a generic basis. But there are different types of returns you can calculate. For example, if you're investing in a business, you need to understand how much is a return on invested capital, or return on equity, right, or return on annual return rate. All of that you can calculate in different ways of investment, different types of investment. But it's a good idea to understand, to start with evaluating how much return on investment you're getting before doing an investment. Now, the next term is asset allocation. Now, Asset allocation is, as I explained, assets, different types of assets exist out there, but you need to be prudent in terms of allocating your investments or capital into different types of asset as a means of diversification, because diversification is important to preserve your capital, protect your capital, because not putting all eggs in one basket, as we would have heard, we all studied in this in colleges. But asset allocation also determines to great extent how much return you're going to get on your investment. So if you put in, like, say 70% of your capital or your income into, or savings into, say mortgages, or into bonds, or into savings into deposits, right, or savings interest, you're not going to make huge return on investments. Your return on investments will be subdued. But if you're going for more aggressive investments, more aggressive asset classes, like for example stocks, or it could be private equity, public equity, all of those things, or your businesses itself, your return is going to be much higher, because those are tied up with higher risk. They come with higher risk carry, and so the returns are also supposed to be higher. But if you are prudent enough in determining the real valuation metrics before you do the investments, your assets could be protected and at the same time get higher returns. So higher returns at lower risk is possible even in equity markets, if you are well aware of the process behind investing. Now that's a different topic altogether, but for now there are different types of asset classes. As I said, real estate, it could be within real estate, real estate could be your houses, it could be rental, for the rental income or rental yield, it could be for dividend yield that you receive from your investment in stocks, it could be your yield from your bonds, it could be gold, it could be commodities. There are different types of assets out there, Bitcoin as recent as crypto world goes into. So there are 7, 8, 9 types of assets. Beyond this, there are investments into art, into silver, into collections, collectibles, tokens. Different types of investments are there. But based on your appetite and risk averse nature, you need to determine what kind of investment spread you need to do, what kind of asset spread you need to do. If you ask me, my approach has been like to invest my assets, investments have been like on a 95% into equities and very less in other asset classes. But that is my risk appetite. Different people have different risk appetite based on the capital, based on the age you are in. So, but understand asset allocation. You can delve deep into it, by doing a research. The next term is equities. As the name says, equities or stock is part ownership of businesses. Equity is nothing but a stake or part ownership in a business, whether it is a public business that is listed in public markets or it could be in private markets. Now, an equity investment is the money that is invested in a company by purchasing shares of the company in the stock. You can purchase the shares through public markets, or you could do it in private. Now, it's typically traded on stock exchanges. Stock exchanges are a mechanism of buying stocks or shares in or equities stake in different companies, right? And why one should invest in equities is because you get the part ownership of company, and your investment capital can rise in value in the form of capital gains. So when you put your money in equities or shares, you get a capital appreciation benefits, because the share price can go up in future due to the company performance, and you also get a share of profit pool, because the companies usually give dividends from their profit pool, right? And also you can look at increasing your ownership in the share or equity ownership in that company over a period of time by continuously investing more money into it. So that is what Warren Buffett has been practicing, increasing the stake over a period of time when the company proves right over and over again. So equity ownership is a very good way of investing, and or it's also called stock ownership. So it is a very important concept. And finally, the last term you all need to understand with respect to financial aspect or investing is compounding and the power of compound interest. Now, compound interest is nothing but interest on interest. I have done a separate video in detail explaining the power of compounding, which is a must must listen to, because it helps you understand in detail what compounding is, and with a lot of three stories I've put in. Now, interest on interest, as the name says, is a very powerful concept, because when it becomes interest on interest, it's exponential in nature, geometric in nature, and it grows exponentially. Your capital grows exponentially and geometrically than simple interest, which is more of arithmetic progression, right? It's more of calculate only on the principal amount. Now, it's difficult for human minds to conceive the power of compounding, the concept of compounding, because it becomes difficult for mind to calculate it beyond a point of time. Now, compound interest formula we will have studied in school is P into 1 plus R to the power n minus P, and it's on the screen. So P is your principal or initial capital that you put in, R is the interest rate, annual interest rate in percentage terms, and N is the period or the number of terms, number of times you're going to compound, right? So there is a very easy calculation tool available in the link I've shown, and I'll put this link in the description as well. It's investor.gov financial tools. You get the compound interest calculator. You can just play around with the calculator. You can put in the capital and change the interest rates, change the period, and understand how much you need to compound at to achieve certain returns before your retirement planning or before your retirement happens, right? So that's something very powerful. We all need to understand. It's taught in the school, very basic formula, but the real applications relating to financial aspects is way too powerful. So check out my video. I'll put it in the end of this, the link to that video as well, if you want to understand more in detail about compounding. So that's those are the 6 financial terms anybody should understand. I thought just bring this up in a consolidated manner. Hope this was helpful. Thanks for staying with me. Signing off, Sandeep Anand.